Hello. Right, let's start with this chart. It's a beauty. United States of America, the black line is the unemployment rate. You can see it going back from 2000 it is, across and then up through the Great Recession and off, and it's around just over 9% now. Okay, that's quite nice. Well, it's not, but it's represented there anyway. But it's the red line that's so important on this one. We can see it's household income. It's the household income index that people have been taking care of. And again, we can see it's been zeroed at 100 in the year 2000. There was the recession, but then it got above it, and then it dropped down, and it got up again over the reference zero mark of 2000 just at the start of the recession. And then we went into the recession, and it was all, and you've caught up now, haven't you? Look what it's done since the middle or the start of the recession. Or consider it, they said the recession was finished, and look what's happened to the household income index after the recession has finished. Oh, all right, that's a very small turn up right down at the bottom right-hand corner. But isn't that remarkable that there has been an absolute crashing of the household income? That's the median, I think, household income. Different ways of measuring it, but you can see across the top to start with, up from 2000 to the middle of the recession, it was doing what it was doing, but it is doing something completely different now. Household income in the United States is crashing. Obviously, you don't pay your debts back with crashing income. Okay, go on to this one, just because it was such a strange chart, but the New York Times here has picked up exactly the same thing. Real household income has fallen by about 10% since the start of the last recession. Seems as though it was so long ago, with a greater decline after the recession ended. So I'm happy that the New York Times at least has done some due diligence on that chart, and it's obviously genuine and absolutely frightening. The United States will stay within pensions, and they're wrestling with their return rates. Turmoil in Europe, the sluggish economy, and low interest rates are intensifying pressure on public pension fund systems to reduce the annual performance assumptions they use to determine contributions from taxpayers and employees. Some lawmakers and pensions officials are pushing to abandon the roughly 8% annual return assumption set by many public employee funds, saying the rate is unrealistically high given the upheaval in markets around the world and the preceding financial crisis. And it seems that over a 20-year period, they're still within that ballpark of 80%, because the tech run-up, they made some good returns then averaged out. But obviously the last 10 years or the last 5 years are well out. But if they don't, generally what happens is if they don't make those 8% assumptions, then the taxpayer is asked to chip in more money. So this is from The Economist, having a go, I think, really at the nice Governor Nikki Haley in South Carolina. On September the 27th, the governor ordered the 16 directors of cabinet agencies under her direct control to change the way their employees answer the telephone. So now, when phoning, say, the Department of Alcohol and Other Drug Abuse Services or the Department of Employment and Workforces, callers are supposed to hear this cheery greeting. "It's a great day in South Carolina. How may I help you?" Ms. Haley says the new greeting will boost the morale of state workers and help her to sell the state. "It's part of who I am," she declares. "As hokey as some people may think it is, I'm selling South Carolina as this great new positive state that everybody needs to look at." might do it. Edward Harrison, credit write-downs. Earlier in the month, I wrote how the currency is the real release valve for the credit-based economy using a non-convertible, freely floating currency. Are you keeping up with this? Best go and read all of these Edward Harrison articles. It's not about interest rates. If currency revulsion takes hold from negative real rates and people want to flee a country's assets, this will be reflected in the currency. This is why the lower and lower yields on the US go against the canard about bond market vigilantes forcing rates higher. So he says if there's revulsion, it won't be the interest rates going up, it'll be the currency going down. He finishes this article, which I do recommend reading. If you believe, as I do, that the problem is excessive public debt, now we're back to something a bit more that we can get our teeth into, that the problem is excessive private sector debt and leverage due in large part to resource misallocation, in other words, borrowing lots of money and buying houses with it, you probably think growing into asset prices via increasing borrowing and lending is misguided. Debt, income and debt GDP levels are simply too high. The government can act as a counterweight to the demand drag, but the recovery will always remain fragile until you get substantially all of the credit write-downs on unrecoverable loans. The reason financial crises are followed by slow recoveries has everything to do with this. In other words, if you read the article, he's having a go at the government and the Fed and what they can actually do. And basically, the same old thing comes out. Unless you do something about the debt and the amount of debt that people have on their shoulders, you're not going to get anything. Moreover, you want to focus on income and not GDP, because the household sector is indebted and it pays for debt out of income. Higher GDP doesn't make any difference for debt services unless it's felt as income. So you can jazz your GDP up, get a higher number, but unless that's a real high number coming through the people in higher income, median household incomes, then you're getting actually nothing achieved. Try manufacturing inflation all you want, manufacture nominal GDP all you want, until incomes rise enough to support the debt numerator, you get enough credit write-downs so that incomes support the debt denominator, it's not going to work. It's the math. Over in Europe, back where we started, this is Greece, and basically their probably 10-year bond rate, because the 1-year bond rate's about 150%. This takes us back to 1993 and the ratification of the Maastricht Treaty, when Greece's bond rate was just under 25%. It fell down until the euro was introduced, and it was falling down because Greece was going into the euro. And it was low because Greece was in the euro on the predicated on the understanding that the European Union would not let Greece fail. They would be bailed out all the way along until the realization that somehow Greece would have to default. And they're back right up again to where they started. Baffled by recent stock market volatility? Don't be. Silvio's men have the answer. Italian Prime Minister Silvio Berlusconi's Undersecretary Carlo Giovanardi said the government will study if it's feasible to conduct drug tests on stock exchange traders with the help of the Milan Bourse and the country's market regulator. Giovanardi, who is in charge of family policy and drug prevention, said that the abuse of drugs, including cocaine, might explain part of the recent stock volatility. Tue11Oct made the comments in an interview published on Klaus somebody's website, whatever. And he might be onto something. Drugs are certainly the best explanation we've heard of Monday's stock market advance. It was a bit crazy on Monday, wasn't it? In the Telegraph, Philip Aldrich kind of sums up what the politicians are up to with this great Euro thing. The promise was made by President Nicolas Sarkozy and Chancellor Angela Merkel after a bilateral summit in Berlin yesterday, which was once again full of rhetoric and devoid of detail. Both leaders committed to a comprehensive response that they suggested would involve a recapitalisation of Europe's banks, accelerating economic coordination in the Eurozone and dealing with Greece. We are not going into details today, Chancellor Merkel said. The whole package will be ready by the end of the month. And then that'll be the end of it. They will have sorted it out once and for all. Take your bets. Back to Edward Harrison credit write-downs and a similar sort of writing that we had, but this time about the United Kingdom. Annual growth of, well, it's the Vocal Link FTSE 350, but it's the important bits highlighted. Take-home pay index. So it's obvious what that is. The take-home pay index falls to 2.2% for the 3 months to September, down from 2.7% in August. Manufacturing index remained at 2.1. Service index falls from 2.7 down to 2.3. Public sector, small growth from 1.7 up to 2. But that overall number is take-home pay index 2.2. And as Ed says, these numbers are well under the inflation rate and show British consumers becoming victims of stagnating and negative real wage growth. Manufacturing inflation in a wage deflationary environment doesn't reduce the real burden of household debts. If you're going to try asset price reflation, as the Bank of England is with QE2, in the absence of wage gains, it won't be sustainable. You need to increase Labour's share of the gains of or from nominal GDP so that households have higher incomes to support debt service and pay down debt. Have they got it? No, they haven't got it. They have got the problem of how to get the money to the people who have got the debts. Fairly. Or not. That's it. Bye.